In this section, we are actually going to go into a little more detail with the four financial statements. Up to this point, we have covered them at a high level. We've introduced them, but now we're actually going to dig deeper. We're going to start with the income statement and work all the way through the cash flow statement. So the overview here is the four statements themselves. We have the income statement, which is the first one, and we're going to see that each of these four statements actually links to the next one. So the income statement, we take net income, which links to the statement of changes in owner's equity. Then the ending balance of owner's equity links to the balance sheet. And then the cash balance from the balance sheet leads to the cash flow statement. So these four statements do need to be prepared in a specific order, and that is the order. Next, we have the slide detailing the various statements in more detail. So first of all, we have the income statement. There are a variety of different names for this statement that you may see over time. Sometimes it's referred to as the statement of operations, the profit and loss statement. Basically, we have profitability over a specific period of time. It could be a week, could be a month, a quarter, a year, whatever period the company wants to prepare statements for. And when we talk about profitability, we're looking at revenues minus expenses. In other words, do we have more revenues than we do expenses? If so, the difference is profit. Now, the reason this is an important statement is that investors or any other user takes a look at this information and they try to predict how the company will be in the future. They want to know how their investment will do. If the company has had a continual, let's just say a 10% increase in profit year after year, then it's reasonable to assume that perhaps maybe the next year will be 10% as well, absent any other information. So basically, we're making whatever decisions we can with whatever information we have. Now, it's very important to understand that this statement does not reflect the cash changes. So profit, just because we have profit in a particular period, does not mean we have positive cash flow necessarily. Same with revenues and expenses. Just because we have so much in revenues, that doesn't mean we have that amount of cash coming in. The cash flow statement later on digs into more detail on that. Again, I mentioned that the net income from the income statement links to the statement of changes in owner's equity. This is a quick example of what an income statement might look like. Again, it's for a period of time. You have your revenues, whichever types of revenues the company has. In this case, they have $175,000 worth. Then you list out all of your expenses, and then the difference would be your net income. So we have $74,250 more in revenues than we do expenses. Therefore, we have net income, profit. The negative to this, if you had more expenses than revenues, it would be called a net loss or just negative net income. The statement of changes in owner's equity is our next slide here. And this one is also a period of time. As the name implies, we're just talking about the different changes in various components of owner's equity. So I mentioned early on, we have really two main issues, main items in owner's equity. We have the common stock and the additional paid-in capital. These terms will make more sense in later chapters. We're going to call these just capital or contributed capital. Then we have net income, which feeds into the retained earnings. We talked about that early on. So we have the capital itself, and then we have the earned capital, which is the retained earnings. So net income is the link from the income statement to this statement. It increases retained earnings. We subtract out any dividends paid. That decreases retained earnings. And we also may have treasury stock that reduces owner's equity overall. So basically what we're listing out here is just the various components of this statement of owner's equity, the various things that could cause owner's equity to change. So within this statement of changes in owner's equity, we have a statement of retained earnings, which just obviously focuses on retained earnings itself. We have the stockholders' equity ending balance from this statement of changes in owner's equity that links this statement to the next statement, the balance sheet. Here's an example of the statement of changes in owner's equity. So you'll notice it's for a period, in this case the year ending 12/31/2016. We have beginning balances for each of these various accounts, and then we have a variety of changes that impact one or more of the accounts. Net income is only going to impact retained earnings. A cash dividend, in this case we didn't have any, but normally a dividend would be included there. Stock issuance, this is going to impact your contributed capital. In this case, both the common stock and the additional paid-in capital in excess of par. Now again, that account we have not talked about yet, so that'll kind of carry over to a later chapter. Same with treasury stock. We really haven't discussed that much in detail. Treasury stock is when the company buys back their own stock off the open market, and in this case they're purchasing it, so it offsets the contributed capital. Then later on, if they decide to resell it, they reissue it to the market. That also obviously impacts the treasury stock column. So treasury stock reduces overall owner's equity. All these equity items will be discussed in more detail in a later chapter. This leads us to the balance sheet. This is sometimes referred to as the statement of financial position because it does show the financial position of a company as far as their assets, liabilities, and equity. This one is actually for a point in time, so this is the one statement that is not for the period. So we have the income statement, we have the statement of retained earnings. Those are all for periods of time. The balance sheet is actually a point in time. As of this particular date, here are the balances of our accounts. So it lists out the balances of assets, liabilities, and equities. Now notice we're not going to see anything related to revenues, expenses, or dividends. They've already been closed out to retained earnings in the statement of owner's equity because they all impacted retained earnings. So this is what the balance sheet might look like. Notice the title, it says as of 12/31/2016. So we have all of our assets listed out and their corresponding balances. Then we have the liabilities and equity components with their corresponding balances. Now we're back to the statement of cash flows, the final statement for this particular, or the final statement that is required. This one, we're back to a period of time. It shows how cash has changed throughout the period. So it explains why we've had an increase of, let's say, $200,000 in cash. It tells us why. It reconciles the beginning cash balance to the ending cash balance and explains the changes. As I mentioned earlier, it's important to understand that cash flow does not necessarily tie directly to revenue and expense. There is often a timing difference because of the accrual basis of accounting. So just because we record revenues in a particular period does not mean we need to receive the cash that same period. Same with the expenses. Just because we record an expense which hits the income statement does not necessarily mean that we have paid the cash that period. It's all about a difference in timing. And finally, we have an example of a statement of cash flows. One of the other topics that will be covered in a later chapter with cash flows is the separation of the three types of activities. So the cash flow statement is broken into three categories: operating, investing, and financing. And it's important to understand which types of transactions fall under which category. That's what determines where you're going to report it. So just a quick overview here. Operating activities, as you can imagine, these are the core operations of the company. These are the items, the transactions that the company is in the business to do. So they receive money from their customers from selling a product to them, providing a service, whatever. And then they pay bills, basically. They buy the inventory, they pay salaries, pay interest, pay taxes. These are all operating activities because they are related to the core operations. You should expect the majority of the company's transactions to occur in this section. Investing, this relates to long-term assets that the company has bought, whether to just hold for an investment or whether to use in their company overall. And then we have the financing activities, which this is how they finance. They borrow money, they issue stock, and then maybe they pay money back. So we get a subtotal for each of these categories. We have a net increase in cash in this case. We add that to the balance at the beginning of the period to find out what the balance at the end of the period should have been. So we will go into each of these statements in more detail in later sections, but for now this should provide a good overview of the four statements.